silver just delivered a brutal wake-up call. In the last 24 hours, XAG/USD rallied hard on Monday, August 10th, surging over 3% to print a fresh 7-week high at $66.07, according to FXStreet data. Traders were piling in, betting on a breakout. Then, this morning, the floor gave way. As of 11 a.m. London time, silver has tumbled nearly 2%, sliding back to around $64.80. That is a gut punch reversal, wiping out more than half of Monday's explosive gains in a single session. The question is not just what caused this, but whether the rally was ever real to begin with. The answer lies in the bond market. Yesterday's silver surge came despite a rise in US Treasury yields, which is normally bearish for non-yielding metals. Today, that divergence snapped back with force. The yield on the 10-year US Treasury note inched higher again after a surprisingly hawkish research note from UOB, warning that the Federal Reserve's current prolonged pause still carries genuine hike risks. Higher yields make the US dollar more attractive and raise the opportunity cost of holding silver, which pays no interest. In plain terms, when the dollar strengthens, it takes more dollars to buy the same ounce of silver, so the price falls. This morning, the dollar index jumped 0.4% and silver got crushed. This reversal is not just a chart pattern. It has real consequences across the market. Late bulls who chased the breakout above $65.50 are now trapped, their stop-loss orders triggering a cascade of automatic selling that accelerates the decline. Silver mining stocks, particularly those tracked by the iShares Silver Trust, opened lower in London, with Fresnillo and Hochschild mining each dipping over 2%. Retail traders on platforms like IG and CMC markets are reporting margin calls. Volatility in XAG/USD options has spiked, making hedges expensive. The takeaway is clear: when a rally is built on momentum rather than solid fundamentals, the exit can be savage. Looking ahead, the near-term direction hinges on whether $63.50 support holds. That level marks the 50-day moving average and a prior resistance-turned support zone. If it breaks, the next stop is the psychologically important $60 handle, last tested during the sell-off earlier this month. On the upside, $66.50 is now the ceiling. With U.S. Consumer Price Index data due later this week, any upside surprise in inflation would fuel fresh hike expectations and likely drive silver deeper into the red. Conversely, a soft print could revive the rally, but the margin for error is razor-thin. The UOB note specifically flags the risk of a Fed move in September if core inflation remains sticky above 3%. Here is the honest takeaway. Monday's rally to $66.07 was impressive on screen, but it lacked the backing of falling real yields or a weaker dollar. Today's sharp fall confirms that silver remains at the mercy of macro forces. For now, the path of least resistance is lower. Watch the 10-year yield and the dollar index minute by minute. If you are long, protect your positions. If you are sitting in cash, patience could be rewarded with a better entry. In the current environment, the white metal is not flashing a safe haven signal, it is a risk asset in disguise. This is your analyst, signing off with one clear message: trade what you see, not what you hope.